The stock market is a place where fortunes can be made or lost in the blink of an eye. But how exactly does it function? From individual investors seeking growth to massive corporations raising capital, the stock market plays a crucial role in the global economy. But what happens between the scenes when you buy or sell a share? How do prices fluctuate? And who decides their value? Here is how you can get started. The stock market is where people buy and sell shares of companies. Think of it as a big online marketplace where businesses offer pieces of themselves, called shares, for people to buy. These shares can be traded on various platforms, including major stock exchanges, like the New York Stock Exchange or the NASDAQ. Besides these exchanges, there are also over-the-counter markets where trade happens directly between investors without going through an exchange. When people talk about the stock market, they often mean major stock market indexes like the Dow Jones Industrial Average or the S&P 500. These indexes track a big chunk of the market by showing the performance of a group of companies. Since it's impossible to keep an eye on every company out there, people use these indexes to get a sense of how the market is doing overall. If you see news headlines saying the stock market has gone up or down, it usually refers to changes in these indexes. For example, if the Dow Jones is up, it means that the overall value of the companies in the index has increased. Conversely, if it's down, the value has decreased. These changes reflect how stocks in the index have gained or lost value. Now that you know what the stock market is, you might wonder how it actually works. When you buy a stock in a public company, you're purchasing a small ownership share in that company. The stock market operates through a network of exchanges, such as the New York Stock Exchange and NASDAQ. Companies list their shares on these exchanges through a process known as an initial public offering, or IPO. This allows them to raise money to expand their business. Once the shares are listed, investors can buy and sell them among themselves. Here's how it typically works. Buyers place a bid, which is the highest price they are willing to pay for a stock. Sellers, on the other hand, have an ask price, which is the amount they want for their shares. The difference between the bid and ask price is called bid-ask spread. For a trade to happen, the buyer must raise their bid or the seller must lower their ask. Most of the price calculations are done by computer algorithms, which help set the prices for trades. On your broker's website, you can see the bid price, ask price, and the bid-ask spread when you buy stocks. For most investors, especially beginners and long-term investors, the difference in price is usually just a few cents and doesn't have a major impact. The U.S. Securities and Exchange Commission, or the SEC, oversees the stock market. Its role is to protect investors, ensure the markets operate fairly and efficiently, and help companies raise capital. In the past, stock trades are conducted in physical marketplaces, but now everything is done electronically through online brokers. Although individual stock prices can vary, they often move together based on news, political events, economic reports, and other factors that affect the market. Now let's break down what the stock market actually does. The stock market is essentially a place where people can buy and sell shares or small ownership stakes in publicly traded companies. It helps distribute ownership of large companies among millions of individual investors. The prices of these shares are determined by the buying and selling actions of these investors, which in turn affects the overall value of the companies. To illustrate, let's consider a company valued at $1 billion, with its share priced at $20. Suppose a large company plans to buy it for $2 billion, pending approval. If investors believe this deal will go through, the price of the shares might rise significantly, perhaps to $40. However, if there is uncertainty about the deal being approved, investors might only be willing to pay $30 or even keep the price at $20. This fluctuation reflects how new information, like a potential acquisition, can impact a company's market value. So how do investors navigate the complexities of the stock market? This is where stockbrokers come into play. Stockbrokers are professionals who buy and sell stocks on behalf of investors. They provide valuable advice, execute trades, and offer insights based on market trends. Their expertise helps investors make informed decisions and manage their portfolios effectively. Additionally, many investors consider mutual funds as a practical investment option. Mutual funds pool money from multiple investors to buy a diversified portfolio of stocks, bonds, or other securities. Managed by professional fund managers, these funds offer an easy way to diversify investments and reduce risk, making them an appealing choice for those who prefer a hands-off approach to investing. Then there's a term as market volatility. So what exactly is stock market volatility? In simple terms, it refers to the fluctuations in stock prices. When you invest in the stock market, you accept a certain level of risk, as prices can go up and down unexpectedly. Despite these, investing doesn't have to be scary. With the right strategies, you can manage these risks and potentially minimize the chance of losing money in the long run. For For example, day trading, where you buy and sell stocks rapidly to take advantage of price changes, is incredibly risky and can lead to significant losses. On the other hand, long-term investing has been shown to be one of the best ways to grow your wealth over time. Take the S&P 500 as an example. Historically, it has delivered an average annual return of about 10% before accounting for inflation. But this doesn't mean that the stock will give you a consistent 10% return every year. Some years, the market may drop significantly, while other years, it could rise sharply. These unpredictable changes are what we call market volatility. It's this volatility that can make investing feel like a roller coaster, with both exhilarating highs and nerve-wracking lows. If you're actively buying and selling stocks, you're likely to make mistakes at some point. Buying when prices are high and selling when they're low, which can result in losses. The secret to safer investing is to stay in the game for the long haul. By investing in low-cost index funds that track the entire market, you can ride out the market's ups and downs. Now that you know how the stock market works, but what it really needs to get started with stock market investing. It's simpler than you might think. You can buy stocks online during regular trading hours, using a brokerage account, robo-advisor, or even an employee retirement plan like a 401k. Investing outside these hours, known as pre-market or after-hours trading, comes with extra risks. You don't need to be an expert to invest in stocks. If you have a 401k at work, you might already be investing in the market through mutual funds, which pull together many different stocks. To buy individual stocks, simply open and fund an account with an online broker who will handle your trades on the stock exchange. Investing in stocks offers the potential for high rewards, but also comes with risks, including market dips. To reduce risk, consider index funds or ETFs, which offer a diversified mix of stocks. Stocks are best suited for long-term goals like retirement, not short-term needs within 5 years. Understanding how the stock market works is key to making informed investment decisions. By grasping its basics, you're better prepared to grow your wealth. What's your biggest question about investing in the stock market? If you found this video helpful, don't forget to like, share, and subscribe for more insights.